and gentlemen, welcome to the Energy Brief with Peter. Today we are discussing the IFRS ISSB Sustainability Disclosure Training or standards for businesses. Basically, what we do is to give you the key provisions of the ISSB standards for business compliance. Now, this initially was a workshop for businesses in my country because the regulators in my country are planning to make the standards mandatory. Then I thought that why don't I just place it on YouTube for the global audience since the standard is a global baseline itself. So whether you're watching from Europe or from Nigeria or from China or America or even India, you will gain a lot from what I'm about to share. So in this video, we'll be looking at different concepts. The concept of sustainability reporting, the IFRS SB sustainability standards itself, the concept of the governing institutions responsible. We'll be looking at the identification and assessment of materiality as it relates to the ISSB standards. We'll be looking at the pillars of sustainability reporting, namely governance, strategy, risk management, the metrics and targets too. Then we'll be looking at scenario risk analysis. This is a very important aspect that you shouldn't skip at all. So make sure you follow through as I proceed. And we'll look at the reporting checklist too. So what the reporting checklist essentially does is that I will go over the old standards, both IFRS S1 and IFRS S2, and deduce the major things, the major features your businesses should note or should consider. So those are the checklists. Then we'll be discussing how your reporting, how your sustainability reporting could align with the ISSB standard itself. Then the most common question these days is the question, how does sustainability profit my business? How does sustainability reporting increases my business cash flow? So we're making a business case for ESG metrics and sustainability reporting too. So just stay put and tune in and share this video too. Make sure you subscribe, make sure you save so you can refer to it later on. So the key terms would be examining in this video, starting with sustainability. So what is sustainability itself? The word sustainability has different meanings for different people. For most, it means reducing wastes, recycling, using eco-friendly materials, cutting greenhouse gas emissions, and for some, it relates to engaging in ethical labor practices. So when we talk about sustainability, another thing that comes to mind is sustainable development. Sustainable development is the development that meets the needs of the present without compromising the ability of future generations to meet their own needs. And the most common global standards for sustainable development is the UN, that is the United Nations 17 Sustainable Development Goals. So a sustainable business enhances long-term shareholder value by satisfying the needs of all its stakeholders, adding economic, environmental, and social value through its core business functions. So a business that wants to venture into sustainability may look into the UN 17 SDGs to see, okay, which aspect should I, is it SDG 17, is it SDG 14, which is universal access to energy, is it SDG, um, any of the SDGs basically. So you can venture into any of them. So sustainability risk and opportunity now, which the ISSB standards relate to, are the risk and opportunities that relate to how your company's capacity to produce cash flow is closely tied to its engagement with stakeholders, the society, the economy, and the environment across its value chain. So the relationship between a company's cash flow and its stakeholders and its environment is what we call sustainability risk and opportunities. So the next term we'll be looking at now is the climate change. Climate change rather. What is climate change? It refers to long-term shifts in temperature and weather patterns. So when we say climate related activities, we refer to activities that promote climate change mitigation and adaptation. So climate related risk and opportunities then refer to the activities in which, or to the ways in which climate change and climate mitigation and adaptation efforts can impact business activities positively or negatively. So the next term that is there is ESG metrics. ESG refers to environmental, social, and governance. So ESG metrics provide organizations with a structured framework for evaluating their environmental impact, social responsibility, and governance practices. Then, sustainability reporting is another important concept that you should be aware of. Sustainability reports is a kind of report, a document or document basically that provide a strategic picture of a business and explains how a business creates and sustains value now and in the future. It is also known as ESG reporting. A sustainability report is the main tool available to an organization to voluntarily communicate. It's a tool of communication of performance, you understand, of impact, communication of impact, whether positive or negative in ESG matters to the stakeholders. The information in the report must be relevant to stakeholders that read them, basically. Then to the key term, the ISSB. The ISSB is an acronym for the International Sustainability Standards Board, which was established in November 2021 by the IFRS, that is the International Financial Reporting Standards Foundation, as the UN Climate Change Conference, COP26. Their mission is to deliver a global baseline of sustainability disclosures that meets capital market needs, that is the financial market needs. So if you're asking why the IFRS has the authority to expertise, know that IFRS also houses the International Accounting Standards Board, a standard that has been adopted by various countries around the world as the major accounting standard. So IFRS dictates how a company prepares financial statements, and it has been also accepted globally. So the fact that IFRS dictates financial statements means IFRS to dictate sustainability reports, because sustainability reports are related to the financial statements of the company. They must be presented alongside with the financial statements of the company in a reporting year. So the Financial Reporting Council of Nigeria, that's for the Nigerian viewers. Yeah? So it's the federal government agency that is established to adopt standards by the International Accounting Standards Board, basically. So they are in charge of implementing sustainability reporting also in Nigeria. Yes. So I won't say too much about that since we have a mixed audience here. So I'll just go straight to the ISSB standards. That's the overview of the ISSB standards. Now, the ISSB standards are designed to be the foundation for a comprehensive global baseline of sustainability disclosure, specifically focused on the needs of the investors and the financial markets. So the standards were issued to integrate sustainability reporting with financial reporting of companies. So integration of the sustainability aspect and the financial aspect, the environmental aspect, social aspect, and the money making aspect of a company. So who is a reporting entity? Who is meant to report? A reporting entity is an entity that is required or chooses to prepare general purpose financial statements. So any entity that is preparing financial statements is an entity under the ISSB standards also. So as we're all aware, uh, all countries require companies to provide annual returns, prepare annual returns and financial statements. So with some exceptions too. So financial statements now must now comply with the ISSB standards. That is the sustainability reporting in the ISSB standards. So when the standards become mandatory, the enforcement government agency will be able to enforce it against companies that are described as entities, companies that submit financial statements. So it's the adoption now depends, the style of adoption depends on the country. So this is not a general rule, basically. But what you should note here is that financial statements, that sustainability reporting is required for businesses that present or prepare annual returns and financial statements. So the ISSB standards are divided into two. That's the IFRS S1 and the IFRS S2. The IFRS S1 is on the general requirements for sustainability disclosure. So what the IFRS S1 does is it requires an entity to disclose information about its sustainability risk and opportunity that is useful to existing and potential investors and capital providers. That is information about sustainability that is useful to investors in a company or potential investors. So so that they can see your sustainability risk before they make decisions on providing money or capital to your business. So this sustainability risk cover various topics such as human capital, biodiversity, community support, energy efficiency, climate change, and all that. So these are the sustainability risks. They are as broad as possible. Now, the second branch of the standards, which is the IFRS S2, it is the one that requires an entity to identify and disclose climate-related risks and opportunities that could affect the entity's prospects over short, medium, and long term. So just note that while IFRS S1 relates to sustainability in general, The IFRS 2 is particular on climate-related risk and opportunities. So there are two types of climate-related risk. We have the physical risk and transition risk. The climate-related physical risk are risks that result from climate change that can be event-driven or that's a result of longer-term shifts in climatic patterns. So you have issues like flooding, like drought, like um, various physical risks that that are inherent in climate change itself. Meanwhile, the climate-related transition risk are those risks that arise from efforts to transition to a lower carbon economy. That is, to a, maybe your country has net zero goals um, or energy goals and all. So these are the energy transition risk. So this transition risk could include policy, could include technology. Some countries are mandating wind power or electric bikes or electric vehicles. Sorry. So these are the kind of technology transition risk. And then we have market and reputational risk also. The reputational risk exists in the form of the customers' preference, consumers' preference as to um, businesses that are considering climate-related risk and opportunities. So some consumers take cognizance of that before making decisions. So that's a risk in itself. So both type of risk carry financial implications for entities in form of damage to assets or reduction in the value of assets or any other negative financial implication also. So an entity is further required to disclose information about its managing the identified climate risk and opportunities. So aside from listing the risk and opportunities, you are meant to name your strategy or to explain your strategy. We'll talk more about strategy later in this video. So the applicability um, the the sorry. Now, identifying risk and assessing materiality. Once all sustainability related risks and opportunities that could reasonably be expected to affect an entity's prospects have been identified, the entity then needs to consider which of the sustainability risks and opportunities are material. We all know the meaning of materiality, relevance. So IFRS 1 places it that only material information needs to be disclosed. Only material information needs to be disclosed. This means that with all standards, with all sustainability reporting standards, an entity does not need to disclose any material information, any immaterial or irrelevant information, even if required by the standards itself. So, and then this is consistent with the definition of materiality that says information is material if omitting, misstating, or obscuring that information could reasonably be expected to influence decisions that the primary users make on the basis of that information. So that is just materiality in itself. So there's more to that, but this is the basic thing you need to note about materiality. Then there are four pillars of sustainability disclosure. Well, the IFRS Sustainability Disclosure Standards are based on the four pillars. These four pillars were gotten from the TCFD framework. So the four pillars are governance, strategy, risk management, metrics, and target. So the standard requires an entity to disclose material information in relation to each of the four pillars. The pillars are then deployed to assess materiality. So in most companies' sustainability reports, you see section segments on each pillar. That is on governance, on strategy, on risk management, on metrics, and their target. So these pillars apply to both IFRS S1 and IFRS S2. So when I'm explaining each of them, I'm explaining them in relation to both standards. So first is governance. The governance related disclosure requirements help prime users understand the entity's governance processes, controls, and procedures that the entity uses to monitor and manage sustainability risks and opportunities. So the key activities under governance include describing the board's oversight of climate risk, climate related risk and opportunities, or describing management rules in assessing the risk and opportunities. So the second pillar is strategy. Strategy. An entity is required to disclose information about its strategy and the actual and potential impact of the risk and opportunities, that is, both sustainability risk and opportunities and climate related risk and opportunities on the business strategy and financial planning. So key activities under this pillar include like describing the effect of the risk and opportunities on the entity's strategy and decision making. Uh, Describe the risk and opportunities that affect the entity's prospects over time, maybe in short term, medium term, or long term. So it also describes qualitative and quantitative information about the current and anticipated financial effects of sustainability risk related risk and opportunities on the entity's financial position. So it takes into consideration how the risk and opportunities have been factored into the entity's financial plan. So it answers the question how, how. So you should get that. Then for risk management includes the processes that the entity uses to identify, assess, prioritize, and monitor identify sustainability risk and opportunities. So risk management is all about monitoring and prioritizing. So disclosure is now required about the extent to which and how these processes integrate into the entity's overall risk management process. Because ordinarily, a company, a business is meant to have a risk management framework. So most companies don't have risk management framework that concerns sustainability or climate activities. So once they form out risk management framework that concerns this, they now need to integrate it into the overall risk management process in the company. So under this pillar, you need to describe the inputs and parameters used, such as information about data sources and the scope of operations covered in the process of reporting your sustainability activities. And then you have to describe whether and how the entity uses scenario analysis to help identify sustainability risk and how the nature, likelihood, and magnitude of sustainability risk are assessed. So there are different activities under this pillar. Then in the aspect of metrics and targets, which is the fourth and last pillar, an entity, a business, needs to disclose the metrics and targets used to assess and manage relevant risks and opportunities where such information is material. So materiality is key here. So once sustainability risks have been and assessed rather as material, IFRS S1 and IFRS requires an entity to disclose information to enable the primary users understand the entity's performance in relation to industry-based metrics. Industry-based metrics. So the IFRS subscribe or prescribe that the SASB standards, SSB industry-based metrics rather should be added to when considering industry-based metrics and other um, external industry-based metrics that apply to a business activity. Now, for each target in the metrics, an entity is required to disclose any milestone or entire target, performance against the target, and analysis of changes or trends in the entity's performance, basically. So, under this pillar, an entity or a company is required to disclose the metrics used by the organization to assess risk and opportunities in line with its strategy and risk management process. It's also essential that under this pillar, the entity describes the targets used by the organization to manage climate-related risk and opportunities and performance against targets. E.g., for example, if a company, for example, Nigeria sets a net zero goal of um, the Nigeria set a target of achieving net zero by 2060. So that is a target in itself. So a company that is drawing up sustainability reports and drawing up risk and opportunities you as regards metrics and targets now would have to consider that 2060 targets of achieving net zero. So that is an example. There are various examples that one can use here. So uh, another activity under metrics and targets is the use of scope 1, scope 2, and scope 3 emissions. So scope 1 emissions is that direct greenhouse gas emissions that occur from sources that are owned or controlled by the entity. For example, emissions from the combustion in the entity's furnaces at its factories, or indirect emissions. So that is scope 1 emissions rather. So that is emissions, direct emissions from the company or an entity controlled by the company. While scope 2 emissions refer to the direct emissions that occur, indirect emissions rather, that occur from the generation of purchased electricity or heat. that an entity uses. So this refers to the greenhouse gases emission emitted at the facility where electricity is generated. So you can see that the company is not generating the emission directly; it is an indirect uh, emission in that instance. So scope 3 emissions and any other indirect emissions outside scope 2 that occur in the entity's value chain. For instance, the employee commuting to work. For instance, the employee is a member of the company, is a stakeholder in the company. So the emissions generated from commuting or from transporting himself to work is considered under scope 3 emissions. Those ones are very difficult to track though. So um, they are scope 3 emissions are form part of the transitional provisions in the ISSB standards. So application of scenario analysis. What is a scenario analysis? Or we should start from what is a scenario itself. A scenario describes a path of development leading to a particular outcome. So scenarios are not intended to represent a full description of the future, but rather to highlight central elements of possible future and to draw attention to the key factors that will drive future development. They are hypothetical constructs. So scenarios are not forecast or predictions or sensitivity analysis. So scenario analysis now is one of the tools organizations can use in order to get a better understanding of their resilience to climate related risk and opportunities, to sustainability related risk and opportunities. IFRS defines scenario analysis as a process for identifying and assessing a potential range of outcomes of future events under conditions of uncertainty. So when you think about how you might use scenario analysis, well, one of the things you need to think about is what is your business? What is your business? What are the most relevant risks for you? And how how can you solve this risk? And how can they evolve? How can the risk evolve in different scenarios? So the IFRS encourages the use of scenario analysis because they recognize that the impact will play out over many different time horizons. So you can't predict the future, but you can predict how the future will look like. You can calculate what the future will seem like. That's what calls scenario analysis. And so you've got to be forward looking. And I can't think of a better tool before looking really than scenario analysis. Then under the strategy pillar, if climate related scenarios such as a kind of scenario is an assumption that planets will be hotter by 2 degrees Celsius by the year 2050. If that kind of scenario were used to inform the organization's strategy and financial planning, such scenarios should be described. So the risks and opportunities for the company under that scenario of the planet melting by 2050 would then be reported. The planet will melt by 2050, that was just an example. So the questions for scenario analysis here, there are different questions you need to ask yourself. Have you conducted this scenario analysis? If not, do you have plans to in the future? And then, how often do you plan to conduct this scenario analysis? What are the scenarios you look at? Consider what other organizations in your industry are disclosing and which scenarios they are using. So, what are the different possible pathways to the particular scenario that you've set or another scenario in another context? So, what are the critical parameters? You have to ask yourself, what are the critical parameters, assumptions, and analytical choices that underline the climate related scenarios or the sustainability related scenarios that you've drawn up. So this might include policy assumptions, energy development pathways, and technology pathways. So there are different scenarios there. So then you have to determine how resilient is the organization strategy against the scenario analysis. That is, if there are areas that they may be affected by climate risk and opportunities, how does the company plan to manage this? And then how are the results from the scenario analysis used by the organization to inform its strategic decision making and financial planning? So under the metrics pillar, you may also ask, do the metrics disclosed support the company scenario analysis and the strategic planning process? Do they enable monitoring of the organization's business environment from a strategic and risk management perspective? So that's the questions. Those are the questions you need to ask considering scenario analysis. So of course you need to align your reporting. We will talk about the process of preparing and presenting climate change and sustainability related impacts, risks and opportunities in annual reports aligned with ISSB standards. In order to align reporting, IFRS S1 requires an entity to publish its sustainability related financial disclosures and annual financial statements at the same time. So in addition, the entity sustainability related financial disclosure must cover the same reporting period as is used for the financial reporting purposes. So if you are presenting your annual report for a particular year, the sustainability report also must be for that particular year. So this will help to address the objective of providing primary users, stakeholders, investors with comparable financial and sustainability information. So IFRS S1 and IFRS S2 are effective for annual reporting periods beginning on or after 1st January 2024. So with early adoption permitted. So however, entities are permitted to report requirements in IFRS S1 only to the extent that they relate to the disclosure of climate-related information in the first year of adoption. This means an entity may only disclose climate-related info in its IFRS S1 in the first year of adoption while applying the requirements of IFRS S1. So the entity is still reporting both standards, but IFRS S1 will be limited to climate-related information. You know that we said earlier that IFRS S1 deals with sustainability, but in the first year of reporting, an entity is allowed to consider only the climate aspect of sustainability in its IFRS S1 reporting rather. So it's a transitional provision to allow businesses to transition smoothly from the current status quo to the ISSB standards. So the entity will still be reporting both standards, that is both IFRS S1 and IFRS S2, but IFRS S1 will be limited to climate-related information. And in the second year that it applies the standards, that is in the second year of reporting based on ISSB standards, an entity will be required to provide information under IFRS S1 about its other sustainability risks and opportunities. So this will allow entities time to build capacity necessary to report consistent, complete, comparable, and verifiable sustainability-related financial disclosures. So another transitional provision is the scope 3 greenhouse gas emissions. So as I mentioned earlier, an entity is not required to disclose scope 3 greenhouse gas emissions in the first step of applying the IFRS sustainability disclosure standards. So IFRS also permits entities in limited circumstances to omit information about sustainability-related opportunity that is otherwise required um, by an IFRS standard if that information is commercially sensitive. So if you have like a trade secret that relates to sustainability-related opportunities, then you are entitled to not disclose them because they are commercially sensitive. So there are actually three requirements that an entity needs before deciding whether an information is commercially sensitive or not. So the first requirement is that the information about the opportunity is not already publicly available. So it is not something public domain already. So the second requirement is that the disclosure of that information could reasonably be expected to prejudice seriously economic benefits the entity would otherwise be able to realize in pursuing the opportunity. So it talks about prejudicing the commercial and economic benefits from the opportunity. And the third requirement relates to the fact that the entity has determined that it is impossible to disclose that information in a manner that would enable the entity to meet the objectives of the disclosure requirements without prejudicing the economic benefits. So we are talking about economic or compromising commercial and economic benefits taken here now. So those are the requirements for classifying an information as being commercially sensitive, and so you may choose not to disclose them. So the reporting checklist now. This is some of what we've been saying since morning. So I've tried to collate them into a list, although they are not meant to be exhaustive. They are just meant to guide you in preparing your own checklist. So first thing first, you have to do an identification and assessment of materiality and judgment. Then you have your governance disclosure, your strategy disclosure, your risk management. Like I said, each of these pillars would have been segment in your sustainability report. So your risk management disclosure as it relates to both IFRS S1 and IFRS S2, basically metrics and targets, comparative information, which may be excluded in the first year of adoption because in the first year there's nothing you are comparing with, which is in the second year that you cannot compare with the first year. And then statement of compliance also this applies to IFRS S1 alone. So our last part is the business case for sustainability reporting. business case for sustainability reporting. I think this video is long. It's already. I would like to break it here, but that will allow you to digest well before we move into the business case. That is why is sustainability profitable. What business value does sustainability hold? So, in order to enable you answer that question, the video will be out in the next release. Yeah, let me put it that way. So, thank you very much for watching and have a good day.